It's our week 3 weekend update video. Hello, everybody. This is Professor Hassey speaking to you again live and in color from Claremont, California. We're wrapping up our studies for the past, present, future in finance, which is the time value of money. We are looking at a review quickly of assignment number 1. The grades are posted. And also we're looking forward to next week, our discussion of bonds and stocks in a little bit more detail and next week, all leading up to our midterm examination coming up in a week or so. You have assignment number 2 this week, due Sunday. Again, if you need extra time, please let me know, but please let me know. If you don't let me know, then I will have to put down a 0 if I don't get anything by midnight on Sunday. So let's first of all just take a quick look at where we stand in the class right now as of our weekend update, week 3. Okay, right now we have books. Well, let me just say I'm having some sound problems here. Let me just double check this. One moment, please. There we go. Technology troubles as always with Professor Hassey. This desktop that I use here in my home in Claremont is 5 years old. It's time to get a new one. I hope Santa brings me one this Christmas. But going back to where we were, here's where we stand right now. You should have 3 grades posted to your grade center. Grade number 1 will be the student bio and portfolio grade. That's the discussion post of week number 1. If you have completed the editing of your portfolio, you'll see a grade in that grade area. If you have not completed an edit, which I ask you to send you back a reply to your work, please do so to get a grade for that. Second grade will be the student professor meeting that we had last week. If you've participated in that, you'll see 100 as your grade for that. And the third grade now is assignment number 1. If you participated in that and posted some work, you'll see a grade in that. So up to that point in time, up to this point in time, 15% of your course grade has been determined in that cumulative average you see in your Blackboard. This week, we have assignment number 2, which is posted on Sunday, which has to do with the time value of money. And that is 10% of your course grade. So after this week, you'll have a quarter of your grade determined in this class. And then next week on Monday, I will post our midterm examination, which will be 20% of your course grade. The midterm examination is a take-home work that summarizes the first 5 chapters of the course. It summarizes it as regards to definitions, calculations, and such. Your assignments 1 and 2 will be a study guide for that midterm examination. Also, you'll update your portfolio for your midterm examination as of Friday, November 18th. At the close of the market on Friday, November 18th, you will update and complete a new an updated spreadsheet of your portfolio. That's why it's imperative that if you have not edited your portfolio per my request of week number 1, you will get that problem wrong on the midterm if you do not clean up your portfolio and get it edited and ready to go. So that's where we stand. So coming into this week, after assignment 2, we will have 25% of your grade calculated. You can go to your grade center, to the front page of your Blackboard, and see your cumulative grade. If any of you have any questions, concerns, unknowns, please get in touch with me immediately. And then we can make sure those problems and questions are resolved before it gets any farther along in our class. Next week is the halfway point of our class. Hard to believe, but it is. So again, as we've discussed in our professor meetings with me, if you have any concerns or questions, I am always available, and please feel free to contact me. So that's where we stand in class right now. Okay, I've posted the solutions to the assignment number one file folder in Blackboard. Here are those solutions. We did pretty good on it. We had a couple of areas. Naturally, the big problem of trying to determine the financial income statement of that business that I gave you, that was a little bit difficult for some students. But again, assignments are only worth 5% of your grade. It's a learning, it's like homework. It gets you prepared for the midterm. So let's just walk through that quickly and go over it. The number of points given in that, I returned, if you had any points taken off, I returned your file with the corrections. Corrections are usually in yellow or green highlights with red marking the amount of points taken away. What are the goals of financial management? Very simply, to maximize corporate value, specifically maximize shareholder value. It's that simple. What are the functions of the financial markets? Functions of financial markets like the stock exchange, the commodity exchange, banking system allow for many necessary and important functions, including providing the abilities to transport cash across time, transfer risk, provide liquidity, and allow for greater diversification in investing. Financial markets channel savings to corporate investment, matching borrowers and lenders. Trading in financial markets provides a wealth of useful information for the financial manager. Looking for something along those lines. 10 points for those two problems. What are the two major decisions made by financial managers? The investment function or capital budgeting and the financing decision. Where do you get the money? And where and how do you get it and where do you invest it? Question 4, multiple choice. Which are the following groups least likely to be considered stakeholders of a firm? Remember, the definition of a stakeholder is somebody who has a financial interest in your business. Naturally, I think the obvious answer here would be competitors. You don't want them to be a stakeholder in your firm. You're competing against them. Government, they're a stakeholder. You pay taxes. Bondholders, they lent you the money. Employees, naturally, they work for you. So the correct answer there is competitors. They are not stakeholders in your company. Select the best answer for the cost of capital. And this is kind of an easy one for most people because really all 4 of these are pretty good determinations of the cost of capital. The expected rate of return on a capital investment, an opportunity cost, is the interest rate the firm pays on a loan. All those 3 are specifically good answers for the cost of capital and represent cost of capital. The best answer is D. For risky investments, it's normally higher than the firm's borrowing rate. And that kind of sums up all those first 3. But again, in this problem, I pretty well took any answer you gave. Question number 6. Which of the following information is not provided by the financial markets? Microsoft earnings. Microsoft earnings are provided by Microsoft to the financial markets. All the rest of the 3, the price of gold, the cost of borrowing, and the cost of wiring money, all are driven by supply and demand in the financial markets. But Microsoft provides the information to the financial markets, but they are the source. So the answer is C. And here's the fun one, which drove some students nuts, I assume, but it was a good way of looking at how finance managers look at the income statement of a company. Knowing the key areas of what each type of revenue, expense, or cash transaction occurs. So here the key thing is you have to split what are income statement items first, revenue and expenses, from the other information given to you. So and you're asked to find 3 areas. Earnings before interest and taxes, which is $160,000. Net income, which is $78,000. And cash from operations, $98,000. Those are the answers. So the key thing is to, first of all, put together the income statement, revenue minus expenses. So we're given in the problem sales of 500,000. Then we're told $10,000 cash dividends. Well, cash dividends is not an expense of a company. Cash dividends is a cash going out of the company for financing. It's a financial cash disbursement. $300,000 cost of goods sold, that's an expense. $20,000 administrative expense, $20,000 depreciation expense, but depreciation, remember, is a non-cash expense. $40,000 interest expense, and then $10,000 purchase of productive equipment. That's another name for $10,000 being spent on assets, fixed assets. That is not an income statement item. It is a cash disbursement for investing from the cash flow statement. Cash for investing in future growth. No changes in working capital and a corporate tax rate of 35%. So first of all, wiping out cash dividends, wiping out and not including $10,000 purchase of productive equipment, those are not part of this analysis. Secondly, here's my income statement. Sales, less cost of goods sold, less administrative expenses, less depreciation expense, gives me my earnings before interest and taxes, $160,000. Answer number one. Interest expense is $40,000. Income taxes are $42,000. How did I get that? Well, if I subtract interest expense from earnings before interest and taxes, I get $120,000. 35% of $125,000 is 120,000 is 78,000. Thus, my income taxes, are 42,000. 35% of 120,000, there we go, are 42,000. Thus, that's my income tax expense. And then subtracting the 42,000 from 120,000, I get answer number two, net income of $78,000. And then finally, what is the cash flow from operations? Well, cash flow from operations is a combination of net income, depreciation, and changes in working capital. Accounts receivable, inventory, accounts payable, and accruals. Short-term working capital. We know our net income is 78,000. We know our depreciation is 20,000. And we know there are no other changes in working capital. 78,000 plus 20,000, our cash flow from operations is $98,000. Remember the three financial statements: income statements, balance sheet, and the statement of cash flows. The statement of cash flows is made up of three areas: cash flow from operations, cash flow from financing, cash flow from investing. I wanted you to find cash flow from operations. So there you have it. Question number 7, worth 10 points. Question number 8 is basically a definition of chapter 4, financial statement analysis of the key measures of leverage, liquidity, efficiency, and profitability. What do these all represent? I was looking for all 4 being explained: leverage, liquidity, efficiency, and profitability. Question number 9, define a profit and loss statement. Another area name for that is the income statement, a statement of revenue less expenses. Then I wanted you to pick one company from your portfolio and determine and find the earnings per share. What does it indicate to a firm and an investor? That was important. If you didn't give me some idea about that, you lost some points. So I want you to go back 3 fiscal years to find the earnings per share for your company. 3 fiscal years. Did that pretty well. Then I wanted you to take the same company and go to the balance sheet and their income statement and determine for the most 2 recent fiscal years current ratio, current assets divided by current liabilities, debt ratio, total liabilities divided into total assets, profit margin, net income divided by sales or revenue, and return on total assets, net income divided by total assets. Those two numbers for the most two recent fiscal years, and what do they represent as an analysis of the business? Current ratio is a statement of liquidity, the short-term management of funds available to the company. Debt ratio is a statement of leverage, the overall debt position to assets of the company. Profit margin is a indicator of profitability, the relationship of net income to the sales that the company is making. And return on total assets is another indicator of profitability. It's the relationship of profits to the assets invested, total assets to get those profits. That's what I was looking for question 11. 15 points for that one. Sum it all up, 100 points, and your grade is posted to the Grade Center in Blackboard. Any questions on that? Please let me know. Okay, our subject this week is the time value of money. We had a good spreadsheet in our lecture video on Monday, introducing the week about explaining the time value of money, how to do the calculations in the spreadsheet. Remember, that is in your week 3 file folder in Blackboard, that spreadsheet that could come in handy to explain calculations using spreadsheets for the various types of time value of money: present value, future value, present value of annuity or cash flow, amortization. Here's a video I'd like you to watch explaining this process again in a different perspective.
Whenever we talk about money, the amount of money is not the only thing that matters. What also matters is when you have to get or when you have to give the money. So to think about this, or to make it a little bit more concrete, let's assume that we live in a world that if you put money in a bank, you are guaranteed 10% interest, 10% risk-free interest in a bank. And this is high by historical standards, but it'll make our math easy. So let's just assume that you can always get 10% risk-free interest in the bank. Now, given that, let me throw out scenarios and have you think about which of these that you would most want. So I could give you $100 right now. That's option 1. I could, in 1 year, instead of giving you the $100 immediately, in 1 year, I could give you $109. And then in 2 years, this is kind of option 3, I'd be willing to give you $120. So your choice is, someone walks up you up to the street. I can give you a $100 bill now, a $109 bill, or not a $109 bill, $109 in a year, or $120 2 years from now. And you know in the back of your mind you can get 10% risk-free interest. So given that you don't have an immediate need for money, you're assuming that this money you will save, that you don't have to, that you don't have a bill to pay immediately. Which of these things are the most desirable? Which of these would you most want to have? Well, if you just cared about the absolute value or the absolute amount of the money, you would say, hey, look, $120, that's the biggest amount of money. I'm going to take that one because that's just the biggest number. But you probably have in the back of your mind, well, hey, I'm getting that later, so there's maybe something I'm losing out there. And you'd be right. You'd be losing out on the opportunity to get the 10% risk-free interest if you were to get the money earlier. And if you wanted to compare them directly, the thought process would be, well, let's see, if I took option 1, if I got the $100, and if you were to put it in the bank, what would that grow? What would that grow to based on that 10% risk-free interest? Well, after 1 year, 10% of $100 is $10. So you would get $10 in interest. So after 1 year, your entire savings in the bank will now be $110. So just doing that little exercise, we actually see that $100 given now, put it in the bank at 10% risk-free, will actually turn into $110 in a year from now, which is better than the $109 1 year from now. So given this scenario, or given this kind of situation or this option, you would rather do this than do this. You're better a year from now, you're better off by $1. What about 2 years from now? Well, if you take that $100, after 1 year it becomes $110. Then 10% of 110 is $11. So you want to add $11 to it. And so it becomes $121. So once again, you're better off taking the $100, investing it in the bank, risk-free, 10% per year. It turns into $121. That is a better situation than just someone guaranteeing you to give the $120 in 2 years. Once again, you are better off by $1. And so this idea that not just the amount matters, but when you get it, this idea is called the time value of money. Time value of money. Or another way to think about it is, think about what the value of this money is over time, given some expected interest rate. And when you do that, you can compare this money to equal amounts of money at some future date. Now, another way of thinking about the time value, or I guess another related concept to the time value of money, is the idea of present value. Present value. And maybe I'll talk about present and future value. So present and future value. So given this assumption, this 10% assumption, if someone were to ask you what is the present value of $121 2 years in the future, they're essentially asking you, so what is the present value? So the present, PV stands for present value. So what is the present value of $121 2 years in the future? That's equivalent to asking what type of money or what amount of money would you have to put into the bank risk-free over the next 2 years to get $121. And we know that. If you put $100 in the bank for 2 years at 10% risk-free, you would get $121. So the present value here, the present value of $121 is the $100. Or another way to think about present and future value, if someone were to ask, what is the future value? So what is the future value of this $100 in 1 year? So in 1 year, well, if you get 10% in the bank, that's guaranteed. Its future value is $110. After 2 years, its 2-year future value is $121. And so with that in mind, let me give you one slightly more interesting problem. So let's say that let's say we're going to assume this the whole time. That makes our math easy, a 10% risk-free interest. And let's say that someone says that they're willing to give us $65 in 1 year. And we were to ask ourselves, what is the present value of this? So what is the present value? What is the present value of this? So remember, the present value is just asking you what amount of money that if you were to put it in the bank at this risk-free interest would be equivalent to this $65. Which of these two are equivalent to you? And so you would say, well, look, whatever amount of money that is, let's call that x. Whatever amount of money that is times, if I grow it by 10%, that's literally, I'm taking x plus 10% x plus, let me write it this way, plus 10% times x. Or let me write it, let me make it clearer this way. X plus 10% of x should be equal to our $65. If I take the amount, I get 10% of that amount over the year. That should be equal to $65. And this is the same thing as a 1x, or we could say that 1x plus 10% is the same thing as 0.10x is equal to 65. Or you add these two, 1.10x is equal to 65. And if you want to solve for the actual amount of the present value here, you would just divide both sides by the 1.10. And so you get x is equal to, let me do it this way, be a little bit more clear about it. So let's divide both sides by 1 point. And really, that trailing 0 doesn't matter. We're not really too worried about the precision here, because this is actually exactly 10%. So this is going to be, these cancel out. And x is going to be equal to, let me get the calculator out. X is going to be equal to 65 divided by 1.1. $59.09, rounding it. So x is equal to $59.09, which was the present value of $65 in 1 year. Or another way to think about it is, if you wanted to know what the future value of $59.09 is in 1 year, assuming that 10% interest, you would get $65.
This incredible device removes 50 times.
Okay, so we're back. As you can see, that explanation was rather simple, but a good overview of Chapter 5 and the time value of money. And again, I refer you to that spreadsheet that we worked on earlier this week, where we did examples of what that gentleman was just talking about, Mr. Khan. And at the same, looking at the future value of certain amounts of money at specific interest rates over periods of time, the present value of those amounts, taking them back into today's value, the present value of the cash flow being received off an investment of $700 and what it's generating for us compared to the actual investment, net present value, the explanation of amortization and using equal payment periods, equal payments over a period of time where the interest and principal is being adjusted after every payment, how to calculate that. Again, you do not have to be responsible for this chart, but I do have a question in assignment 2 regarding that. So assignment 2 is just going over these points explained in these videos, explained in these spreadsheets, and asking you to calculate that. And also more importantly, and I want you to spend some time on this, is give me a decent example of how present value or the time value of money works in your life, in your professional life, in your everyday personal finance life. Give me an example and explain that to me in the final question of assignment 5. Assignment 5 is fairly quickly, can get through it very quickly, but take your time and give me a good example and explanation in that second question. That's important to me. Okay, that should pretty well do it for our topic of time value of money for this week, number 3. Next week, week 4, we're looking at chapters 6 and 7. Chapter 6, stock valuation. What is a stock and how do you value it? And a bond. What is a bond and how do you value a bond? Looking at the current yield of the bond in the market. We'll be looking at the constant growth or dividend discount model. We'll be looking at bond characteristics, its yield, its price, its coupon, looking at the definitions of what stocks and bonds are, all leading into week 5 when we begin capital budget analysis over a course of a couple of weeks, learning how to take where we get money from investors, stocks and bonds, and investing in assets and using the time value of money, present value, how those investments pay off for us over time. That's the meat and potatoes of corporate finance is weeks 5 and 6 of this course. Weeks 1 through 4 kind of lead us up into that discussion. So again, good luck with assignment 2. Make sure you post it on time. And I will be back with you on Monday, November 21st. Number 14th, excuse me. And we'll be talking about stocks and bonds and posting the midterm examination work and an update of your portfolio in the coming week. So please refer to your grade situation, where you stand. Any questions, let me know. Have a great weekend, everybody, and we'll talk to you again in week 4. Adios.